everyone, and welcome to Rose Finance. Today, we're going to be talking about how to avoid common investment mistakes. Investing can be a great way to grow your wealth, but it's important to be aware of the potential pitfalls so that you can make informed decisions. By the end of this video, you'll have a better understanding of how to avoid these mistakes and make your investment journey more successful. Investing without a plan is like driving without a destination. We're likely to end up lost and frustrated. A good investment plan should outline your financial goals, risk tolerance, and investment timeline. Sarah wanted to invest her savings, but didn't have a clear plan. She ended up investing in a few random stocks based on tips from friends. Unfortunately, the market took a downturn, and Sarah lost a significant amount of money. This could have been avoided if she had taken the time to develop an investment plan that aligned with her risk tolerance and financial goals. It's tempting to chase hot tips in the hopes of making quick profits. However, these tips are often unreliable and can lead to impulsive decisions that you may regret later. David heard from a friend that a certain tech stock was about to skyrocket. He invested a large sum of money into the stock without doing any research. Unfortunately, the stock price plummeted and David lost most of his investment. This could have been avoided if he had done his own research and not blindly followed a hot tip. Emotional investing is letting your emotions, such as fear or greed, dictate your investment decisions. This can lead to panic selling during market downturns or buying into overhyped investments. Emily saw her portfolio value dropping during a market downturn. She panicked and sold all of her investments, locking in her losses. A few months later, the market recovered and Emily missed out on the gains. This could have been avoided if she had stayed calm and held onto her investments for the long term. Diversification is spreading your investments across different asset classes, sectors, and geographies. This helps to reduce risk and protect your portfolio from market fluctuations. Mark invested all of his money in a single stock. When the company went bankrupt, Mark lost everything. This could have been avoided if he had diversified his portfolio across different stocks or other asset classes. Investment fees can eat away at your returns over time. It's important to compare fees for different investment products and choose options that are low cost. Jessica invested in a high-fee mutual fund without realizing how much the fees were eroding her returns. Over time, the fees significantly reduced her overall growth. This could have been avoided if she had chosen a low-cost index fund instead. Taxes can be a significant factor in your investment returns. It's important to understand the tax implications of different investment strategies and work with a tax advisor to optimize your tax situation. Thumb invested in a high-growth stock without considering the capital gains taxes he would have to pay when he sold it. The taxes took a big bite out of his profits. This could have been avoided if he had planned for taxes in advance. Rebalancing your portfolio is adjusting your asset allocation to maintain your desired risk profile. As your investments grow and market conditions change, it's important to rebalance regularly to keep your portfolio on track. Laura invested in a balanced portfolio, but over time, her stock holdings grew significantly, increasing her overall risk profile. She didn't rebalance her portfolio and was exposed to more risk than she was comfortable with. This could have been avoided if she had rebalanced her portfolio regularly. One of the biggest mistakes investors make is not investing enough. The earlier you start investing, the more time your money has to grow. Even small amounts invested regularly can add up to a significant sum over time. Michael started investing in his 20s and contributed consistently to his retirement account. By the time he retired, his investments had grown significantly, providing him with a comfortable retirement income. This could have been achieved if he had started investing earlier and contributed more aggressively. Investing is a long-term game. John was unsure about how to invest his savings and made several impulsive decisions based on gut feelings. He ended up with a portfolio that didn't align with his risk tolerance or financial goals. This could have been avoided if he had consulted with a financial advisor for personalized advice. Review the common investment mistakes discussed and emphasize the importance of avoiding these pitfalls. Encourage viewers to take action, such as creating an investment plan, diversifying their portfolios, or seeking professional advice. Thank the viewers for watching and encourage them to subscribe to your channel for more investment tips and insights.